My name is Michael King, and today we're going to be looking at how to calculate the required return of a stock using the capital asset pricing model. This is going to be sections 9.1 and 9.2 out of Booth, Cleary, and Rikita. So recall that Harry Markowitz was awarded the Nobel Prize for his work on modern portfolio theory, which talked about how we can diversify risk by adding stocks together in what is called a portfolio. This is going to be the basis for the creation of the capital asset pricing model, which was developed by William Sharpe. So chapter 9 in this text has a lot of material and acronyms that are confusing. We're not going to be dealing with them all in this video. Instead, we're going to focus on just a few key ideas which you need and try and minimize the jargon. So we're going to talk about risk aversion and risk premiums, how to combine risk-free and risky securities. We're going to talk about that thing called the capital asset pricing model and the security market line. So two acronyms. And we're going to look at how to use the capital asset pricing model to calculate the required return on a stock. So we assume that investors are risk averse and they want to maximize their wealth. Now, what do we mean by risk averse? Well, they don't like to take risks, and so they need to be paid a premium in order to bear a risk. A more extreme form of risk aversion is that even if there's an equal probability of winning or losing in a bet, they're not willing to take that gamble because they just don't like the downside. And some people clearly don't like to take risk, which is why you see such a large market for insurance, whether it's car insurance, life insurance, or other forms. So think of a risk premium as an insurance premium that needs to be paid for taking a risk. It's also true that individuals differ in their degree of risk aversion. We probably all know someone who likes to gamble and someone who doesn't. And so when we look at the efficient frontier, which we're going to create based on modern portfolio theory, it's going to be clear that some people will be at one point while others will be at the other. Very risk-averse people will probably want to hold a risk-free asset, such as a treasury bill, where there's no downside and there's a guaranteed return. But if you're going to hold a risky assets in order to get that higher return, you expect to be compensated. So this is the efficient frontier that Markowitz was able to derive based on the combination of different stocks in a portfolio. Notice that on the vertical axis, we have the expected return, and on the horizontal axis, we have standard deviation of return. And this is going to be the portfolios that are most efficient, and we want to be along the top part of that line, which is called the minimum variance portfolios. So given that some people will prefer to hold a risk-free asset and others will want to hold the risky asset, the insight is that you can combine a risk-free asset with the risky asset and get different combinations that lie along this blue line. So if the red line is the efficient frontier, then the new efficient portfolio is some combination of the risk-free asset and different portfolios. You can either invest only in the risk-free asset or you can borrow at the risk-free rate in order to buy more of that risky portfolio. Rather than being at portfolio A or B, you would rather be at portfolio A2, which offers a higher return for the same level of risk, or you would rather be at portfolio B2, which is higher return for a given level of risk than portfolio B. This line is going to be called the capital market line, and it is going to be a line that meets the vertical axis at the risk-free rate and then rises with some slope. And that slope is going to be a measure of the amount of risk that you're taking. Now, when we're talking about a full portfolio of securities, we're going to call this line the capital market line, and it'll show the trade-off between risk and return. When we talk about an individual stock or an individual security, we're going to use the same line and call it the security market line. Okay, so what do we see in this picture? We see that you could put 100% of your money in a risk-free security and earn this return, or you could invest in a combination of the risk-free security and the market portfolio and get a higher return. Beta, which is going to be the sensitivity of the market to risk, is going to be a beta of 1. So we're going to look at portfolios that have higher risk or a beta higher than 1, or portfolios that have a lower risk and a beta lower than 1. So William Sharpe did share the Nobel Prize for in the year that he won it for developing this model called the capital asset pricing model to get the required return on a stock. He, of course, had to derive this mathematically and had to make some simplifying assumptions. So he assumed that investors will build efficient portfolios, as outlined in modern portfolio theory, where they're looking to maximize return for a given level of risk or minimize risk for a given level of return. Investors are going to choose some combination of a risk-free asset and a risky asset. Investors are rational and risk averse. They can borrow and lend, and they require a premium to hold the risky investment, and that there's going to be no transaction costs or personal taxes. Now, we know that this doesn't hold in reality, but these were the assumptions that went into building this model. Based on this, Sharpe was able to show that the optimal risky portfolio is going to be what he calls the market portfolio, which is a portfolio made up of all investable assets. All required returns for individual stocks are therefore going to be priced relative to this market portfolio. So they're going to either be higher or lower in terms of the required return based on whether they have higher risk than the overall market or lower risk than the overall market. So based on that, Sharpe came up with this formula here that you see, which is called the capital asset pricing model. And it basically says that the required return K for a stock is going to be a function of its sensitivity to market risk, which is going to be measured by this symbol B for beta. Okay, and you can see that the formula has a risk-free rate as the benchmark. And then you get some sort of premium, which is the difference between the long-term return on the market minus the long-term return on a risk-free asset, multiplied by the riskiness of that asset, okay, which is going to be measured by the beta. Again, when we're talking about portfolios, we refer to this as the capital market line, but when we're talking about individual securities, meaning one stock, we're going to call it the security market line. I prefer to simply call it the CAPM formula. And the CAPM formula not only allows you to get the required return for a stock, if you flip it on its head and look at this from a company's point of view, this is going to be how a company thinks about the cost of equity that they need to pay investors when raising money by selling equity. I prefer to use a different formulation from what's in the textbook. The cost of equity, or the required return, is equal to a risk-free rate, and notice that there's a T here for it's at a specific point in time, plus beta times an equity risk premium. Okay, so the risk-free rate is the rate that you would be looking at on the day when you're measuring this, and it would be typically proxied or measured using a long-term government bond, such as the 30-year bond yield, but it could also be a 10-year. The idea being that when you look at buying a stock, your alternative investment would be just to buy a government bond instead. So in order to buy that stock, you have to be at least offered the return on a government bond. That beta is going to be a measure of the sensitivity of the stock you're looking at to changes in the overall market, and we'll talk about how to calculate that in a moment. And then there's going to be this risk premium, and this risk premium, which is going to be called the equity risk premium, ERP, is going to be the long-term average return on stocks over and above the long-term return on bonds. So typically people will estimate this looking at the past 100 years. How did you do holding a portfolio of stocks versus bonds? And in North America, you've typically earned a premium of around 4 to 6% per year. But this equity risk premium does vary by country. Now, some people do call this the market risk premium, or the MRP. So we use this formula, the CAPM formula, to calculate the required return of a stock. So if you're given the risk-free rate today, say of 3% for a long bond, you know that the stock's beta is 1, meaning its sensitivity to the market is the same as the overall market, and the equity risk premium is somewhere between 4 and 6, call it 5%. What will be the required return on this stock? Okay, here's the formula. All we do is we plug in the inputs. We see that if you add 3% plus 1 times 5%, you get that the required return on the stock should be about 8. This, in fact, is the average return on the overall stock market over longer periods of time. Notice that if beta goes up, then the expected return goes up. So if your beta is 1.5, what would be your required return? Well, you simply substitute 1.5 into that formula. You see 3% plus 1.5 times 5. You see that you would expect to be compensated by getting a required return of 10.5%. Because the market is made up of more risky and less risky stocks, you can have stocks that have a lower beta. So if the beta is only 0.8, what would be the required return? Well, we see that the required return would be 7%. Let's try another calculation using the CAPM formula. This time, we're given that the cost of equity or required return is 6%. We know the risk-free rate is 2% and the equity risk premium is 5. What beta would this imply for this company? Okay, so we have the formula. Now we just have three inputs. We have to calculate the fourth. So if we know that the cost of equity or the required return is 6%, the risk-free rate is 2, and the equity risk premium is 5, we can back out that beta must be 0.8, okay, which means that it's below the average for the overall market. So do people really use the CAPM, you may be wondering? Yes, they do actually. It's the industry standard when you need to calculate the required return on a stock. Or put differently, it's the way that companies figure out what their cost of equity is. Now, the pros are that it's simple to apply and it's very simple to interpret. If I tell you it's 8%, then you know that's what you expect to receive. But the cons are that it's not clear that the assumptions that you put in are realistic. Of course, there's only three inputs. And if interest rates are artificially low, or if you use a different equity risk premium from other investors, you're going to get a different required return. Recall that this is relative to the market portfolio. So there's a big debate out there about what the market portfolio should be. Is it the S&P 500? Is it all stocks? Or is it all investable assets? Stocks, bonds, real estate, gold? Well, there's no clear answer on that, but that's something that we will leave to the academics. Okay, so let's look at an example of how you calculate a cost of equity. Let's say a company has its stock trading at $25. The next dividend is $2, and that's expected to grow at a constant rate of 4% per year thereafter. If the risk-free rate for government bonds is currently 5%, the stock's beta is 0.75, and the market risk premium is 8%, what would be the required return or the cost of equity for this company? You can see from this information that we've given you more than you need for doing the CAPM. That's one of the ways you could calculate it. Obviously, you could just use this formula. However, you could also use the constant growth dividend discount model. In this case, you would simply reformulate the formula and you would put the dividend over the price plus the growth rate of dividends, and that would be another way. So here's your inputs. Using the cost of equity using the CAPM, the formula is risk-free rate plus beta times the equity risk premium. The risk-free rate is 5%, the beta is 0.75, the equity risk premium is 8%. You can see that the cost of equity or required return is 11%. In this case, using the dividend discount model, using this formula, you put the dividend of $2 next period over the current price of 25, which equals to 8%. You add the growth rate of 4% and you get an estimate of 12. And this is typical what happens. Using different methods, you will get different estimates because these are two different models, neither of which is correct.